Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies and Tesla stock. To begin, we'll be analyzing an article titled, "Is SoFi stock a buy?" So in this particular story, we will be weighing the pros versus the cons, the bull thesis versus the bear thesis, so you can have a great overview of the good and the bad regarding the stock, and the opportunity to invest will be up to you. So we'll be going over their latest news updates, their approaching catalysts, their price targets, as well as the good and bad for this stock so you can make an educated investment decision. After that, we'll talk a little bit more about Tesla's overall financial report because they brought in their Q1 earnings report and they actually missed expectations, which is weighing very negatively down on the TSLA stock price. So Tesla stock is falling right now, but honestly, I think this is a great buying opportunity. So for more videos on SoFi Technologies as well as Tesla stock, remember to go and annihilate that like button right now. Comment your thoughts down below about which of these stocks you own. Subscribe if you are new, and without further ado, let's jump right into today's stories. If you clicked on this video, you probably already know that SoFi Technologies is a fintech company or a financial technology company that offers an all-in-one inclusive digital app giving their consumers access to various financial products and financial services. Essentially, SoFi Technologies operates as a digital bank, and their ticker symbol is SOFI, where their share price has fallen by almost 2% today. Now, I do think that SoFi, or at least companies like SoFi, are the future. For instance, Ally Financial, SoFi Technologies, and other companies that are taking a digital-first approach to finance are, in my opinion, going to be the future. And many other investors agree with that because the company has surged by around 28% this year alone. However, investors aren't completely oversold for this overall company because it has dropped by around 77% since their peak. So if you are an investor who jumped into this company too early and you are in the red, then maybe you should lower your exposure a little bit to this company because you're taking on unnecessary risk of losses. However, in this video, we're going to be determining if SoFi stock is a buying opportunity right now. So let's examine both the pros and the cons for this company. We will start by talking about the reasons to buy SoFi Technologies. And of course, first off, we're going to talk about their overall resiliency and safety. Despite the overall banking sector being very volatile and many investors saying that there is trouble ahead for this particular space, SoFi has been fundamentally pretty solid. For instance, as of December 31st, 91% of SoFi's deposits are FDIC insured, meaning that it can give investors as well as their customers a peace of mind by investing and even having money in SoFi's overall bank. Their FDIC insurance is far more competitive than traditional banks, to where traditional banks will only give you FDIC insurance up to around $250,000, but SoFi offers insurance up to $2 million, again giving their consumers a peace of mind. SoFi is also protected from rapid interest rate increases due to their overall business model and the various segments and revenue streams that they already have set up. Many bullish investors will also highlight how SoFi Technologies has grown their overall revenues extremely aggressively over the past few years, to where the company has more than tripled their revenue from 2019 until 2022. On top of that, they also grew their overall membership base from just 1 million up to 5.2 million members. And for the year of 2023, management anticipates and forecasts that their revenue will jump another 25 to 30% on a compounding annual growth rate. So in essence, they are rapidly expanding, rapidly growing, and their financials are reflecting this very good news. Right now, SoFi stock trades for just $5.97, while a very negative bearish analysts believe the company should be worth at minimum $5. However, more bullish positive analysts believe this company could be worth as high as $10 by the end of the year. I am more in the middle, thinking that the company is probably worth around $7.30, considering the negative macroeconomic environment that we are in right now. The company does seem to be very well positioned, because if they fall below $5, it makes them a great buying opportunity, or if the company surges to $7 or above, even up to $10, you hopefully are going to receive a lot of benefit from that, but don't overexpose yourself. I personally only have around a 4% allocation to this company, because if I invest more than a 5% initial allocation, I deem that as improper risk management. So make sure to not overexpose yourself to risky singular growth stocks, because that would be bad risk management. Now let's talk about some of the reasons why investors want to sell sell this company. First, let's start off by talking about how this company is not profitable yet, meaning that they haven't reached a point where they are actually bringing in profits, but hopefully as time goes on and as the revenues scale, we will see the company become profitable. And right now it's projected that SoFi Technologies will become profitable in Q4 of 2023, which is really something to look forward to if you are an investor, which should clearly move the overall SoFi share price upwards. However, there is still a lot of execution risk for this company achieving profitability in Q4 of 2023, and this may not even be reflected until Q1 of 2024. So don't hold your breath too much, but eventually this company is supposed to become profitable in the short term, so if you are holding until that happens, then feel free to do so. However, another negative bearish perspective is that the competition in this fintech space and just in financial institutions generally is extremely competitive. SoFi does offer a wide range of products and financial services, like offering credit cards, debit cards, a brokerage account, various insurance products, banking services, and many other things. However, there are a plethora of other institutions and financial organizations and firms that do the exact same thing. So when comparing SoFi Technologies to their peers, we need to actually understand which is the better company and which of these companies are more attractive to members. Now, I personally think that SoFi has one of the best APRs in terms of savings and checking accounts, and they also have very competitive interest rates if you want to borrow. However, the competition is scarce, and I personally am invested in a plethora of banking institutions and other financial firms, such as JP Morgan Chase, Bank of America, Ally Financial, SoFi Technologies, and a few others. I even have a Charles Schwab and Goldman Sachs, so it's not like I'm only betting on SoFi Technologies. The whole financial space is set to win over the long term, and regardless of what company comes out on top, I probably already own them. So I'm just using SoFi to diversify my overall portfolio. But given these risks, I'm going to leave it up to you whether or not it's going to be good for your portfolio, because everyone has their own variables involved in different risk tolerances. So I'm going to have to leave this up to you, but just remember, don't overexpose yourself to any singular risky growth company. That is improper risk management, and I hate to see people get burned when they think that one company is going to go to the moon, so they end up investing way more than they actually should. Remember to stay safe, don't overexpose yourself, and enjoy the ride. Up next, let's talk about Tesla's TSLA stock and why their share price is falling right now by over 8%. Tesla is an electric vehicle manufacturer that also specializes in energy generation as well as energy storage. And recently, the TSLA stock price has tumbled, which means for Tesla stock holders that you are really feeling the heat right now. But in my opinion, this is the greatest opportunity to buy this company right now. They're trading for just $166, which is a substantial discount. And the reason why they are falling in their overall share price is that once Tesla released their earnings, the results were not what investors expected. For instance, for the first time in more than 3 years, Tesla's margins have fallen below 20%. And a clear competitive advantage for Tesla is their very high margins compared to their competition. Tesla, despite cutting their overall prices for their vehicles 6 times since the start of the year to reinvigorate demand, this is negatively impacting their overall margins as well as their overall financials. For instance, Tesla reported first quarter revenue of $23.33 billion, which failed to meet Wall Street's expectations of $23.35 billion. Also, when we look at their earnings per share, their adjusted EPS came in at 85 cents per share, which again was below estimates because investors thought they were going to bring in around 86 cents per share. So not only did they miss on their revenues, but they also missed on their earnings per share. Lastly, when Tesla reported net income of $2.9 billion, that means they brought in $700 million less than the prior period, which is not good. So in regards to the reaction, I think some investors are overreacting, but the cheaper Tesla can be, the better buying opportunity it becomes. Due to this recent earnings report, Wall Street experts, professionals, and analysts have slashed their overall price targets for this company. For instance, a Jefferies analyst maintained a buy rating for the company, but he did end up cutting his overall price target down from $250 to $230. However, clearly this implies that Tesla still has a great amount of upside, considering that they're trading at just $165 as of right now, but by the end of the year or over the next 12 months, the company could surge, according to this professional, to $230. Another reason why investors are less than bullish on this company, at least right now, is that their production is outpacing demand. Tesla has cut their overall prices to increase demand because they are making so many vehicles they need to be able to sell them. Otherwise, they're just going to be sitting on lots, depreciating, and the company is losing money. The company said they delivered around 422,875 units for the first quarter, but they produced around 440,000 units, meaning that there are cars that have not been sold yet, and we do not want this trend to continue. This is so concerning that a Wedbush analyst named Dan Ives, which I personally follow because he's a phenomenal professional, who is also a long-term Tesla bull, has lowered his price target from $225 down to just $215. But despite this, I do think this is going to be temporary. Tesla will continue to decrease in their share price over the short term, but I bet the company will surge back up in the future, and right now could be a great time to buy this company on weakness if this current share price is below your average cost. However, again, we don't want to overexpose ourselves too much to singular risky growth companies. We want the majority of our core portfolio to be made up of index funds, mutual funds, and ETFs, such as SCHD, VTI, VOO, MTUM, QQQM, and many others. So I hope you loved this news update, and if you did and you want more videos just like this one, go ahead and obliterate that like button right now. Comment your thoughts down below about any of these stories, subscribe if you are new, and without further ado, I will see you in the next YT video.